Most investors think that they need hundreds of thousands of dollars to build a rental portfolio. But what if you could buy one property, fix it up, rent it, pull your cash back out, and repeat? That strategy is called BRRRR. I'm going to break down how new investors can use it without blowing themselves up financially. The first step is to buy the property. Remember, your deal is essentially made at purchase. As an investor, you're not buying retail. You're looking for properties that offer you opportunities for cosmetic fixer uppers, maybe properties that have been marketed poorly, properties that have been on the market for an extended period of time, and of course, properties with outdated interiors. So remember, when looking at properties, you need to have margin. A common rule most investors use is ARV times 70% minus repairs equals your max purchase price. However, keep in mind, not all properties are going to follow this exactly. Here's where most beginners miss using this strategy, though. If the deal only works on paper with perfect numbers, the deal doesn't work. Build in a cushion using conservative numbers to give yourself a chance of success. Step two is the rehab. This is where you can create value. Focus your repairs on kitchens, bathrooms, flooring, paint, and curbside appeal. Avoid luxury or expensive upgrades. Your renovation should only increase value, increase rent potential, and that's it. Don't over improve for the neighborhood your property is in. Step three, rent your property out. Once you've completed renovations, it's time to place a qualified tenant. So remember, you need to make sure you're running background checks, verifying income, and using a solid lease. You need to have market rent that supports your refinance too. So make sure when looking at what your refinance is going to look like that market rent supports those numbers, because the refinance is the next step, and that is where your magic happens in building your portfolio. Step four is the refinance. After stabilization, which is typically 6 to 12 months from the date you purchased the property, depending on the type of financing you're using, you can then look to refinance into long term debt. The goal with the refinance needs to be three things: pull out most of your initial cash, lower your rate if you used hard money in the financing of your purchase, and lock in 30-year financing if possible. If your property appraises high enough and rent supports the payment, you now own a cash flowing rental with much of your capital invested now returned to you. That's where the wealth building engine really picks up steam. Step five is to repeat the process. Now that you have taken your capital back out of the property, you're ready to do it all over again. That's how investors can scale up from one property to 10 properties or more. And they do so without consistently saving for new down payments. But remember, this only works if you use conservative real numbers. All right, let's go with a conservative example of what I'm seeing many investors here in Colorado take advantage of. Let's say you buy a property for $400,000. Your renovation costs $80,000. So your total investment into the property is now $480,000. After you're done with renovations, you have it appraised for $640,000. When you go to refinance, assume a 75% loan to value or a new loan amount of $480,000. So you've essentially recovered most of your $480,000 investment minus any refinance closing costs that are incurred through the refinance. You still own a property that will have a solid rental cash flow after you're done. That's how a clean BRRRR is accomplished and how many investors look at their numbers when going into this before making that decision to purchase. Here are just a few of the common mistakes I see investors make when using the BRRRR strategy. Many investors get into trouble because they've overestimated the ARV, or they've underestimated rehab costs, or they're ignoring potential holding costs, or they're assuming refinance numbers that they think they'll be able to achieve without verifying through a trusted mortgage broker upfront. And lastly, many investors forget to keep adequate reserves on hand after the transaction is complete. Remember, if your appraisal comes in low or some of these other issues pop up, It's not a deal killer. You just may be forced to leave a little bit more cash into the property than you would like. That's not always fatal, but it's something you need to be prepared for. So remember, when employing the BRRRR strategy, you need to make sure that you're leaving yourself margin and liquidity in order to be truly successful. All right. So BRRRR is one of the most powerful strategies that investors who are looking to build a portfolio can use. But remember, it's only successful if it's structured correctly. The property matters, but the financing structure matters more in the end. So make sure you're working with a great and trusted mortgage broker, along with a real estate agent who not only understand your short and long-term goals, but have a solid understanding of what it takes to be successful when employing the BRRRR strategy.